Afternoon, ladies and gents. Simon Brown here. Just check that you're getting audio, that you can see the screen which Alec is sending. If you just raise your hand in the GoToWebinar application. Brilliant. Hands are plenty. It's kind of fastest finger first in a sense. So Alec Hogg from BizNews.com is doing a global portfolio using the Standard Bank web trader. This is our second in the series, putting together a portfolio with a $200,000 account. But with that, I'm going to hand over to Alec. If you've got questions, drop them in the Q&A box. As they come up, we'll take those questions in real time rather than waiting for the end. But of course, you can take questions at the end as well. Alec, all yours.
Good stuff, Simon. Yeah, I think it's nice to make it a little more interactive. We learned a little bit from our first time around, and hopefully this time we'll be able to also give you some very good insights. What we've done with the portfolio, and it's perhaps a technical reason, but otherwise also to help people, those of you who are now picking up for the first time on WebTrader and being able to make your investments offshore, as we've started again. It's not that we were losing money. In fact, we were quite nicely in profit over the last 3 months, but we've taken all those investments and we have now allocated them as of yesterday. The strategy is, and as you'll see as we go through the portfolio, the strategy is to phase in your investments over a period of time. So don't go and lump everything in today. Try and work it out, have patience, work it out over the next 3 months. That's exactly what we did to begin with. But with the portfolio, to just give you a starting base, as it were, that's where we've actually begun. So let's get into it right now. As you can see, the big story of the moment is oil. Unquestionably, it is a game changer. Everything, all old bets are off. Over the last little while, we've seen the oil price absolutely plunge, and I'm going to just take you through the Brent crude oil because that's the one we follow most closely here in South Africa. That's a 3-year graph taken off BizNews, and if you go back to what has happened since roughly the middle of this year, where we were at $110 a barrel, as you know, today we're around $70 a barrel. That is an extraordinary change to the investing environment, certainly the economic environment. And here in South Africa, Kees Bruggemans has done his numbers. He reckons that we could see a lift in the economic growth rate next year by 2.5%. The figures coming out of the United States are actually so big, you don't even want to start trying to calculate them. But it has to be a seriously bull point for the economy, which in the same instance is a bull point for shares. And we see what's been happening to the S&P 500. That is an area where 30% of our portfolio is invested. We've invested it in the Spider fund, the S&P 500 fund. I'll get onto that in a moment. But just to show you that perhaps the best time to have bought in would have been just about the time we started our portfolio. So it's only fair to now go back and rebase everything, which we've done once again. But as you can see, that would have been a really nice time to buy the S&P index somewhere between around 1850. As it's now approaching well over 2050 and approaching 2100. My feeling on this is that I'm very comfortable to be fully invested in equities, despite the naysayers who do feel that there could be a correction, and there always is a correction. Nothing goes up in a straight line. We do have fundamentally a very good base from which to start looking at corporate profits into the future. All right, let's get into our individual stocks. The first one, which I mentioned a moment ago, is the S&P 500 index. The second one is Berkshire Hathaway. And what we've done with the structure of this portfolio is actually quite simple. We've taken the S&P for 1/3 of the investments, and then another 1/3 of the investments are allocated between two stocks: Berkshire Hathaway, which in itself is a little bit like the S&P 500, and also Google, which is the greatest company on earth as far as the business model is concerned. Well, certainly I'm of that opinion, and I can tell you that value investors worldwide went scrambling out to buy Google a couple of years ago after, at the annual general meeting of Berkshire Hathaway, Warren Buffett said he and Bill Gates have spent hours trying to work out how to beat the Google business model, and they can't find a flaw in it. And more the value investors are coming to that realization. But why Berkshire Hathaway? Well, it is an enormous company, the 5th biggest by market cap in the United States. It is very focused on the U.S. economy, which is going to get a good boost from oil. So anything that lifts the economic growth rate in America will lift Berkshire Hathaway. And the other interesting part about Berkshire is, as you can see from this graph, it has been outperforming. This is a year-to-date graph. It's been outperforming the S&P 500 index quite handsomely. And this after it struggled in the previous 5 years. Now, it's interesting to note that Berkshire has been under quite a lot of criticism because it was not doing, it hadn't up until the annual general meeting this year, ever in its history, in the 50 years that Warren Buffett has been running it, it had never underperformed in a rolling 5-year consecutive period, the S&P 500 index. And it had done that at the beginning of this year. We came back, had a look at the numbers again, ran through everything for Berkshire, and it was very clear to me there, and I think to many other investors, as you can see, from around about July, August, that the shares started outperforming the S&P 500, which is not bad going at all, considering what the S&P has been doing. Just to remind you that we are standing by for your questions. So if you...
Alec, I got one that just came in. Which S&P 500 tracker do you prefer? Because there's a bunch.
No, that's it. It's SPDR VOO. So it's the one that you'll find on the web trader platform. Mm-hmm. You put in VOO colon. It just put in VOO.
It'll find it.
Yeah, it'll find it. It's actually it's a really good system, Simon. The web trader system. I know it's back in Saxo Bank, but I've played on it a lot, and it's very, very easy to use. That's the one I like. And is there any way that we can open the portfolio for the public at some point in time, so that you can go in, investors could actually go into there. Maybe we should invest.
I'll have a chat with that. I tell you what, the VOO, because I was looking at total expense ratios. Total expense ratio, 0.05%. It's not even a rounding error.
Well, makes you eat your heart out, Netflix, doesn't it? Sure. Yeah, 0.05%. How do they keep it so low? I suppose through lending stock.
Yeah, and it is even the other one I was looking at was 0.1. That's cheap, but in their parlance, that's expensive.
Extraordinary. Well, it just shows you then why there's such a strong pro-passive investment lobby. Because if you think of 0.05%, as Simon has just told us, and you compare what you're paying in most actively managed funds, the active managers got to really motor just to beat the market. So we love the market as a big chunk of our portfolio. 1/3 of it's there, but we love Berkshire Hathaway I can't say even more, because otherwise we'd have more than 15% invested in Berkshire Hathaway. But if you get the strategy, we've got a nice strong base in the ETF, in the VOO or the Vanguard S&P 500 index. And that will give us a nice tracker of where the market's going generally, almost like your banker, if you like. And then we look for stocks that will outperform it. So that's the strategy that we've been employing here. And so far, so good on Berkshire Hathaway. I think it's only just starting to outperform, though, because it has been lagging for a few years. And you'll see in this portfolio that comes through quite strongly. Just to give you a little bit of background again about what Berkshire Hathaway is, what it is. It employs about 300,000 people. It's been run by Warren Buffett. Next year it will be his 50th anniversary, and he is the ace capital allocator, which is really what you want to have in anybody who's running a company that you put your money into. It has over 80 subsidiaries, and it has $100 billion invested in its own portfolio. So this is a seriously large business. But one that is extremely decentralized, 24 people in the head office. I wonder if any South African head offices could compare from that size. Let's move on to the next stock, Google, which I did mention before. So we have Google owning 15%. We own 15% of our portfolio in Google and 15% of our portfolio in Berkshire Hathaway. Why Google? Well, it's a company that I know very well, having run internet businesses myself now for the last 14 years, I think, no, 17 years. What am I saying? No, since 1997. I've been investing my time and energy trying to understand how the internet works and how the economic model goes. And I can tell you that there's a flood of people who are going into the internet area, but so far they just don't even know what they don't know. It's Google, on the other hand, knows a whole lot more about how this industry is developing. It also knows how it's transforming the world, and it is, on top of all of that, if you like these kind of things, which I do, it has a motto which says, don't be evil. That simple. Google is transforming the advertising model, not to the benefit of people like myself, because we have to think much, much harder to make money in the media space. But we are seeing the media industry completely resize, and Google's already generating huge amounts of cash, and there's no way of changing it. I can assure you that there have been many people who are trying to poke holes in the model, not least Bill Gates, the founder of Microsoft, and Warren Buffett. And although Buffett doesn't own the shares, that's only because he only owns shares where he can forecast what's going to happen to the profits in 5 years' time. And he says it's not possible for him to forecast that in Google's instance, so he hasn't bought any shares. But he also says it's the one company that he finds impossible to see where, at this point anyway, an alternative business model would come through. So that's good enough for me. We've got 15% of our portfolio in Google, and this is a graph I really like. The time to buy Google is when it is relatively undervalued. You're never going to get it cheap. There are too many smart people on this earth who are looking for an opportunity. But if you have a look at the way it is underperformed this year, the Nasdaq, which is where it is listed, you'll see that there is an 18% variance between where Google is and just the average of the Nasdaq. So whatever you hear about tech stocks being in expensive territory, and whatever you hear about them being overrated or overpriced, that may well be the case. But I'm sure if you took the tech stock index and dropped it by 18%, there would be a flood of money jumping in there. And that's really what you're doing buying Google today. So underperformed the Nasdaq. This is the time you want to be investing in a stock like this one. Remember, our portfolio is a long-term buy and hold portfolio. I do not expect, unless in exceptional circumstances, to be doing any selling. We are hoping to be judged on this portfolio in 5 years' time. But for the moment, you've got to time your entry right, and timing your entry into Google right now is certainly not a bad time. Right, moving on to the next one, and here's one that I've been, over the last few months, if there was one of the stocks selected where there was criticism, it's this one. Amazon.com, the operation run by Jeff Bezos, the founder of the operation, and a man who, in the same way as it's worth reading the Berkshire Hathaway annual letter to shareholders, and Yanni Mouton's letter to shareholders here in South Africa of PSG, it should be required reading to read Jeff Bezos's letter to shareholders. Once you read that, you understand where he's coming from. And they've had a misstep again, this time with the Fire, the Kindle Fire, which didn't fire.
Oh, that phone.
The phone, yeah. And he said, well, we gave it a go. It didn't work. We lost $470 million. But that's what makes us grow. But the reason why you can actually buy Amazon more cheaply is because of that misstep. Again, like with Google, if you have a look at the underperformance here, it's even greater. Amazon has underperformed the Nasdaq by over 30% this year. You're not going to find much better opportunities, relatively speaking, than buying Amazon right now. And I've put that little headline there, "Oh, ye of little faith." I have faith in Bezos. I have lots of faith in Amazon. It is a company that's been run for the long term. And as a long-term investor, I can't find a better spot. Okay, no more questions at the moment.
No, folks, if you've got questions, send them in. Everyone's been quiet on us.
Oh, well, I hope that that it's making sense, or at least that the lack of questions reflects that insight. And then on to just to go back a little, what we're doing with these stocks now, Amazon.com and the next two, is we allocate 8% of our portfolio to them. So getting back to the structure of the portfolio, 30% is in the Vanguard S&P 500 index, the VOO. 15% in each in Google and Berkshire Hathaway. Berkshire Hathaway because it's a S&P 500 on steroids, in my opinion. Google because it is the greatest company on earth. For someone who's been in the internet field, you just can't beat these guys. And then the next three, 8% each in them, are the share picks. The first one we've discussed is Amazon.com. The second one is IBM, and this is a value play. Big blue, big value. It was tipped to me by Nick Shepard-Smith suggested that it was a stock to go and have a look at. I did. I read through the information, and as the graph will show you, whoa, my goodness, I've just gone a little bit too quickly. You see, Simon, I think you wanted to see the pretty lady. Let's just get that one back. My apologies. There's a serious value proposition. Like Amazon.com, hugely underperformed, this time underperforming the S&P 500 index, and this is by nearly around 25%. IBM is one of those cash cows that I like. It throws off a lot of cash. It's got a deep installed capacity. It's very, very hard to switch from IBM, and you'll see this theme going through the next stock as well. If you want to acquire a long-term position, the one thing you have to look for in a company is what is its moat? What makes it different to others in its industry? Why is it going to be around when competition comes, as it always does when you're making excessive profits? And IBM's moat is its installed capacity. That's really what it is. There's so many IBM machines around the world, and it's very difficult to switch from your whole tech background to a new tech operation. They've invested over the years very heavily in their skills of their people, but they've also got technology, which is the new Watson technology, is very exciting and something that certainly the people within IBM say has not been fully appreciated by the market itself. The numbers that did come out in this quarter, as you can see the drop there in the share price, they were a shock, a little bit like what happened with Amazon.com. The investment community wasn't terribly impressed with the numbers, but you've got to see past quarteritis. You have to look into the future, and this is a solid business that is coming to you at a 25% discount to what the S&P 500 index has done this year. Good time to be buying.
Alec, I've got two questions actually coming at me around. So I hold the DBX US, which is the Deutsche Bank US tracker, obviously South African on the JSE. And the question is, am I comfortable? Am I swapping? What's my feelings? A couple of points. It doesn't track the S&P 500. It tracks the US MCSI 600. So it's close enough. It's 98% the same. I'm not selling it to buy US S&P trackers, tax implications and all of that sort of fun and games, but certainly new money that goes in, I'm going to put straight into the US tracker. Key point: Deutsche Bank total expense ratio, including VAT, 0.84 compared to 0.05. So we're talking what? Call it 0.8%. And as I say that, I should just pay the tax, shouldn't I? You know what I'll wait for it to be 3 years old, so I pay the CGT. There certainly is a much bigger cost there.
But the point was you didn't have the opportunity when you started buying that DBX tracker to go into what you can get on web trading.
Yeah, that's just
a sensible idea.
When I can't remember when I first bought it, but there was nothing else. It was, we used to do it the old-fashioned way, which was to buy the dual listed, the Sassels and the like. And then I thought, let's get really clever with it. But that total expense ratio, 0.8, and I'm thinking, I'm still young. It's going to cost me a fortune over the rest of my life.
We've got a photograph on BizNews of Simon and I in the studio, and you can certainly see by the length of his hair that he's very much young. All right, Simon, shall we get to I think IBM has had its time. We'll now go to that picture that you like so much. Novo Nordisk, diabetes, beta. This is a company that has 50% of the anti-diabetes market in the world. It's based in Copenhagen, in Denmark. They produce pretty good companies. Saxo Bank also from Denmark, aren't they? The Danes, they seem to have a knack for business, even though they have a very socialist type of economy and tax system. But Novo Nordisk is an absolutely magnificent performer over the years. It also has a huge moat, because anybody who has diabetes will tell you to get analyzed and to get the correct dosage is a process that you really don't want to go through twice. So once you get through that and you get diagnosed and you get given the correct dosage, you kind of stick with it, or your doctor might just adjust it slightly as you go into the future. So if you own 50% of that market, you must know that you've got a very serious position. Add to the fact that this lady in the picture, of course, is certainly doesn't qualify, but to the obesity factor, the world is getting fatter, particularly the rich world, not exercising as much and eating not as healthily as Tim Noakes would have us. Those kind of issues are also playing in Novo Nordisk's favor. But how's this for a company? This goes back, I went back 10 years, as you can see from this graph, and those big falls down there are special dividends. So this is a company that, going back to the beginning of 2005, off it goes, it throws off cash. It doesn't increase its prices unduly, so it makes sure that the door is not open for competitors to come and grab that 50% of the market. In fact, there are only 3 players in this market, and they're the biggest. So the door's not open for a competitor to come and take them out. And because it throws off cash, and it has enormous, in its business model, it has an enormous reinvestment into R&D. When the cash builds up to the level that it did there in 2007 and again here in 2013, it pays off a dividend. That big increase there in 2014 was after the shareholders complained that it was very difficult to trade the stock, so they had a share split, 2-for-1. And indeed, the implication of that share split, because it was very tightly held, has been extremely positive. So now think of this. You've had 2 massive dividends, but going back to the beginning of 2005, taking those dividends right out, or the special dividends right out of the picture, you're still performing with the S&P. What a business. What a company. And it's one that I was tipped at the Value Investor Conference last year. Rob Viner, who runs a portfolio in Switzerland with just 10 stocks, made this his only stock he bought last year. So he spends I think his portfolio is about 2.5 billion rand. So it's not huge, but it's only him. Mm-hmm. And he then takes that. It's not his own money, I don't think. It's on behalf of investors. But his approach is, I've got 10 stocks, and every now and then I'll add another one. And this was the 10th one that he added. He's also, by the way, a big holder of Google. So that's Novo Nordisk. And that, I think, that's our portfolio. So we've gone through all of them. I'll just to give you a quick run through again, very quickly. There is the Vanguard. Sorry, the world has changed through oil. I need to do Simon, I've got to get a little bit better on this. There we go. On the PowerPoint. Lower oil will stimulate markets. I'm very bullish on this. I don't think that the implications of the oil price decline have yet been absorbed. And we have to thank the Americans and the frackers for it. What's happened on that scene is that you've got OPEC, where there was a lot of confrontation within OPEC before the meeting last week, and the Saudis said, guys, we've got to take a long-term view on this one. We'll keep producing what we are producing. Remembering OPEC only produces 1/3 of the world's oil now. So they're not in the cartel position that they were in, say, 1974. And despite the unhappiness of the other players in OPEC, that they would like to cut back to try and push the price up, the Saudis said, we're not going to push the price up, so we may as well just continue allowing the oil price to go lower until the point where the frackers in America and the oil sands people in Canada are pushed out the market because they produce at a higher level than what the Saudis produce at.
And a question coming through from Mark. He's saying, likes the portfolio, included most of the stocks you recommended, thinking of a high dividend ETF, generating cash, I suspect there, and also perhaps a total world stock ETF to get some sort of global exposure, which I suppose would pick up on the emerging markets, your Latin Americans, Africa, Asia as well.
The first one outside my field of competence. I don't know enough about a high yielding ETF, so I'll pass on that one, and maybe you can give some thoughts there, Simon. On the second one, I really thought hard before going for the S&P 500 rather than the MSCI World. And the way I look at it is the Americans have got this last problem right. They understand they've got quantitative easing in. It is working. The economy is lifting, and the dollar is it was low, but the dollar is now strengthening as a consequence of people wanting to put their money into the United States. It's a very uncertain world that we live in. We know we've got a fellow called Putin who is just ready for a fight, small man syndrome, no doubt, and that could change the European scenario at any point in time, apart from which the European scenario is not a good one. There's structural issues there that is going to take an enormous amount of adjustment before that can come through. So Europe doesn't excite me overly as a location. Of course, there are great companies there, but if you're going to buy the index, you're buying the whole lot. Japan, Abenomics is still in the air. China's had a fantastic run, and can it perpetuate it? Well, it'll be the first centrally controlled autocracy in history that is able to do it. It is growing, according to the Chinese statistics, at 6 to 6.5%, but the market is showing that. And then Africa, and Africa is very small, and Latin America, not terribly enthused by them either. So it's almost like, would you want to dilute the potential upside that you can get from the American economic uplift? And on the other hand, how many of those American or the constituents of the S&P 500 are actually global companies anyway?
Yeah.
Simon, the Americans have got business to a size.
And we've got JSE stuff, which kind of in a sense gives us sort of Africa to a degree. And I get it that a lot of the top 40 stocks are very globalized and the like, but to my mind, that's almost our emerging market exposure just by being on the JSE. Mark, to your point around high dividends, I like dividends, cash flow, nothing wrong with cash flow. At this point, I'm not spending the cash because I don't need to. I have salaries, but it gives me money to deploy back in. And you mentioned the HDV, which is my preferred. It's the iShares High Dividend ETF. Although what you often find in the US is that dividends are sometimes a bit lower. Because of tax, they have a 30% tax rate. You need to apply for the relief at source, which means you will get taxed at only the 15% rather than 30%. And that becomes very critical if you're going into a high div ETF. Alec, Walter's asking about tobacco stocks. He says long-term value propositions. They generate cash. Yep. They pay dividends. Yep. They're defensive. I don't know. I think tobacco stocks are gone in our lifetime. Certainly in the next generation's lifetime, perhaps.
Again, it's not one that I've done enough analysis of specifically, but I don't like buying into dying industries. Yeah. And that's one figuratively and literally. There's a big move on the tobacco side that those who like tobacco stocks might have missed. In India, which is one of the big markets clearly for growth potential for the likes of BAT, they've pushed up the age, or proposing to push up the age, of those who can buy cigarettes from 18 at the moment to 25. Now that, if you don't start, Simon, I used to smoke. And why did I start smoking? Because peer pressure.
You were a kid, same as me. You're a kid, your friends are, you smoke.
And when you do get to the stage where it starts affecting your health, you tend, the older you get, the less you want to smoke because it's inconvenient. If you're pushing that age from 18 to 25, that's your target market. That's the guys you're going to capture for life. That's only one of the bare issues there. People are getting healthier. The internet is making us more aware. It's the same argument I'd have for sugar. I'd stay far away from sugar stocks, and also increasingly the wheat and the grain stocks, because evidence is coming through which is showing us, certainly there's no question on tobacco, but sugar is the knowledge about what sugar does to us is we're becoming aware of. And I suppose further down the line, wheat and other stocks, you don't have to be too upset about that yet. But tobacco stocks, I'd rather go for Google. because Google's doing good.
Walter, I had British American Tobacco. Weirdly, it was a stock I bought knowing I have to sell it, and I'm with Alec. I want to never sell my stocks. I want that to be the problem to my heirs, who I leave them to. But I bought British American Tobacco knowing I'd have to sell it. At a price earnings of above 20, it's crazy expensive. And smoking's on the out. Australia, if you were born after 1st of January in 2000 in Australia, it is illegal for you to smoke ever. New Zealand is looking to do legislation that will ban smoking in the entire country. Forget going into the middle of a field, they will ban smoking. Those are the extremes, but that's where the world is shifting to. India's clamping down. China is not, but China will in time. And you can see that smoking demographics been moving eastwards, and eventually it's just going to run out of space.
Yeah, there's no smokers on Mars. Simon, I'm just going to go through, as you've been talking, I've been going through the portfolio, the value propositions there from IBM and Amazon.com, and then Novo Nordisk is our cash cow. I would, if you're interested in getting cash returns, and if you're interested in that, if that's what motivates you, and you can take a longer term bet, I'd go for a stock like this one.
I'm looking at those two price, they collapses because you were given a fistful of cash.
Yeah, and it keeps doing it. And there's no, in our lifetimes, in the same way as smoking is on a downward trajectory, diabetes sadly is on an upward trajectory. So this is not a stock that has got any headwinds unless the only headwind they could have is if they dramatically change their culture and start jacking up the prices too much, and then people just stop taking diabetes medication, which I guess is just about impossible, or they would then move to a competitor.
Yeah.
So even though in this case generic, the problem pharma companies have is once their licensed products become available to everybody else, then they lose that advantage. In this case, generics really don't matter because the user of the product is the one who's gone through the process of getting onto it in the first instance.
Alec, I'm not seeing any more questions coming through. Shall we leave it there? We agreed on a date for January, and now it slipped my mind.
15th of January.
Thursday, 15th of Jan. I'm just back from holiday. Alec is just on his way to Davos. And we will get back then. We'll do a follow-up with this. And we will do one monthly. I suppose if we're now on the 15th of the month, we'll kind of focus on around picking up one mid-month. Check back, see what's happening with the stock, see how they're doing. Anything adding or subtracting from it. Alec, appreciate the time.
Simon, it's such a pleasure. And, I hope that those of you who attended today and those of you who are watching this or reading and watching this on the recorded system are going to find it just as enlightening. Let's hope that you have a profitable December or whatever you might be doing, and don't spend too much